Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Shopify Incorporated, ticker SHOP. If you shop online, you've likely purchased products from a Shopify store, and the business model here looks really good. So we'll dig into the numbers, see what a price worth paying is, and what kind of growth rate we'd be looking at based on what expectations are. So we're not off to a great start. They had negative earnings, negative net margins this last year. So the numbers do not look the best. They are expected to go positive and actually come in with some decent earnings over the next 2 years. We see some good growth there, but at the moment, things aren't looking very good. Cash flow. This last year, cash flow did look good. Double digits, 14.2%. Usually they're around 8.6%. They do not pay a dividend, and due to them losing money, our ROE and ROA are negative, and ROI is essentially flat. Balance sheet does look like it's in pretty good shape. A 0.25 looks very good. So they don't have debt dragging them down too badly. Gross margins look really good. Seem to be around 50.5% to 51%, somewhere in that range. Net margins, they essentially break even typically. In this last year, they lost money. Looks like the big issue here is mostly expense-wise, because they have really good gross margins, and they're spending a lot to go negative. Revenue growth has been good. Analysts are expecting some continued good growth. 15.2 next year, a 17.65 compound annual growth rate over the next 2. So we're going to use 16 for our thesis, see if they can keep that up for the next 3 to 5 years. Share count, they do issue shares, not a whole lot, typically less than 1%. I wouldn't expect them to go above 1%, 0.75, 8, somewhere, or 0.75, 0.8, somewhere in there is what I'd be expecting them to issue. Cash flows, cash flow numbers are kind of all over the place. If they can grow them 6% per year based on the revenues that we're seeing as well, they come to a cash flow yield of 9% in the next 5 years. So it could be higher than that. In fact, let's say 8%, half of their revenue growth, about 10%. That's really what we like to see. I know it's down from this year, but I'd like to see them continue with the growth before I bank on it. Assets up 1 year, down the next. So not really good story here. Flat, maybe we give them 1% just to see what that does for us. Liabilities, the liabilities were down this last year, and we'd like to see that continue. That's why their balance sheet's in good shape, and it'd be in even better shape. And then we'll assume margins stay relatively flat. As you can see, it takes some pretty big growth just to bring them to break even from the margins that they came in with this year. But with this thesis, we'd be looking at average growth in their fair value of 13%. So that is beating out markets. That is in the range that we like to see. But if you purchase at today's price, just shy of $60, so you are overpaying, and even in 5 years, it's not going to catch up to that valuation with 13. One of the important things that we look for in companies is consistency. And with this one, sometimes you get it, sometimes you don't. Revenue, very good, very consistent growth. Cost of goods, growing as well. In fact, it looks like it's growing slower. But then you get down to the gross, net, and EBIT, and it was okay in 2020, but then 2021, huge negative, basically broke even 2022, back to negative in 2023. This right here, since the EBIT is higher than the net profit, that tells me that they're pretty heavy in paying off interest and taxes. Likely not taxes, since their net profit was negative. So it looks like they are paying a lot of interest in there, which is weird for their balance sheet. They're pretty flat on their balance sheet. Just gradual, small growth there. Tangible assets are nice, big positive numbers. Liabilities are small, and the tangible book value is in line with the tangible assets. So balance sheet is definitely the main story here. They're good on their balance sheet, but there's not a whole lot of value to it because they don't have a lot of assets. Cash flows, they had a down year in 2021, but they do have some really good growth there. And then if we look at everything graphed out together, we see that 2021 was a pretty rough year for them. Everything kind of took a bit of a dip. Potentially, they got a big boost from COVID and dipped down from there. But then things seem to have recovered just fine. Not much of a difference between 2022 and 2023. Balance sheet looks about the same. Cash flow doesn't look like it's moved all that much. Fair value went down just a tad. And earnings went barely negative because they did lose a little bit. But the share price is way up here. And at no point have we seen the share price under any of the valuations. This blue bar, the dividend here, does not matter. Personally, I like the business model. I like the stock. Balance sheet looks great. I'd want them to handle those expenses, and I'd want to get in the 20s. 50s is just too much. So I'd want this thing at half the price it currently sits. And it hasn't been that low in the last 52 weeks. So this might not be a stock for me in my investing style. Even if you got in at the 52-week low, you're still buying it at valuations probably 6 to 7 years out. But if you're purchasing at the fair value, I mean, things are looking incredible there. You're outperforming the market significantly, 3-4x market returns. Anyone who got in at the high, 91.57, is in a world of pain. They probably bought at valuations that another 9 years just about, based on the trends that we're seeing. But there are some positives. Good cash flow yield, good cash flow growth. If they can fix their expenses, get their net margin in line, the stock would be perfect. If they could bring their net margin up above 10%, I would definitely buy. And we'd be looking at a whole different scenario here. We'd be talking about the financial portion of the business coming in a whole lot stronger, potentially up to 50 times what we're seeing right now with a better margin. And that would have a major impact on the valuation of the stock. I think it would take the valuation at least up into the 30s, if not higher. Still, not at the level that we're seeing on the stock, but it's a great stock. It's one of those where maybe rather than having a margin of safety to the downside, you need to have a premium to the upside if you really want to be able to get into it. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.